Welcome back to the Deep Dive. You might know us from our series EGU'd, OGIU'd, where we look at U.S. stocks. And today, we have a really urgent one. We are diving really deep into Navitas Semiconductor. That's ticker NVTS. And the timing here is absolutely critical. Today is November 2nd, 2025. Tomorrow, November 3rd, Navitas reports their Q3 earnings. So we've gathered a whole load of pre-earnings analysis, from top research firms, plus the wider industry context, think AI, EVs, all that power stuff. We're trying to give you the essential insights right before the numbers drop. But there's this huge paradox we need to figure out. NVTS stock, it's up an incredible 259.4% year to date. I mean, just stunning performance. Yet at the same time, they're facing some serious headwinds right now and have actually guided for a revenue decline this quarter, a big one, over 50%. So what gives? Is this rally based on vision or just pure speculation?
Yeah, that's the heart of it, isn't it? That clash between the long-term promise and the short-term reality. It makes this deep dive absolutely essential right now. Navitas is right there at the crossroads. You've got this massive growth potential in efficient power electronics, but then you have the cyclical bumps and the geopolitical stuff messing things up. For any semiconductor company, really, especially one that's high growth, but maybe not quite profitable or at scale yet, understanding that timeline, that risk, it's everything. We really need to pick apart their tech and see if that valuation makes any sense at all.
Okay, let's unpack it then. What exactly is Navitas doing? Why aren't they just another chip company like Intel or NVIDIA?
Yeah.
They seem focused specifically on power.
That's the key. Exactly. They are specialists. They focus on power semiconductors. So these aren't the chips doing the thinking, the calculating. No, these manage how electricity flows, how it gets converted. They're like the essential plumbing, maybe, that makes your phone charger work efficiently or keeps a giant server farm cool and running. And crucially, they're not playing in the old school silicon game, which is super crowded, very commoditized. Navitas is all about these next generation materials designed for high voltage, high speed, high efficiency.
Right, so that brings us to GaN and CAC. Those acronyms pop up a lot. Can you break down what those materials actually are and why they're supposed to be better?
Absolutely. So the core technology revolves around what we call wide bandgap materials, or WBG. Specifically, we're talking gallium nitride, that's GaN. They market it under names like GaNFast, GaNSafe, GaNSense.
Catchy names.
Yeah, they try. And the other one is silicon carbide, or SiDe. So GaN and SiC. Think about it like this. Standard silicon transistors, they've been the workhorse for, 60 years? But they have limits, real physical limits, especially when you try to push a lot of power through them really fast. They get hot, waste energy, need big, clunky cooling systems.
So if you need smaller, lighter, faster power solutions, silicon just can't keep up anymore.
Precisely. That's where WBG comes in. GaN and SiC, they have this wider energy bandgap. Sounds technical, but it enables three huge things. First, much higher efficiency in converting power. Less energy wasted as heat. That's massive when energy costs are a big deal.
Okay, efficiency, got it.
Second, greater power density. This means you can make the components way smaller and lighter. Think about cramming more power into an EV's charger or a packed server rack. Size matters.
Smaller and lighter.
Makes sense. And third, they can handle much higher temperatures and switch on and off much faster at higher frequencies.
So basically, these are the components you absolutely need for all the next-gen stuff involving batteries, powerful computing, things that draw a lot of juice.
That's the strategy, exactly. Navitas has lined up its GABA and Solutioni products to target these huge growing sectors demanding better power management. You've got mobile, think those super fast phone chargers.
Right.
Electric vehicles, the inverters, the onboard chargers, critical stuff there. Data centers, especially for AI infrastructure, which is incredibly power hungry. And then broader energy stuff like solar power inverters. They're selling the enabling tech for the next decade's power demands.
Okay, it definitely sounds like they're in the right place technologically. But where does a niche player like Navitas focus just on power really fit into the whole massive semiconductor market? We're talking hundreds of billions globally. What are the big trends helping them out?
Well, connecting it to the bigger picture, the overall semiconductor market is stabilizing after that downturn we saw in 2023, the inventory correction. It's actually heading into a pretty healthy long-term growth phase now. Global revenue is expected to blow past the 2022 peak. Projections, like from firms like PwC, they see the market hitting maybe $642 billion this year, 2024, and then potentially surging towards $1 trillion by 2030.
$1 trillion, wow.
Yeah, it's huge. That's like a 7.7% compound annual growth rate. pretty consistently.
Okay, trillion is massive, but general chip growth doesn't explain a 259% stock jump for one specific company, right? It has to be something more targeted.
Exactly. You have to drill down. And that's where their focus on power becomes so critical. If you look at what's driving that trillion-dollar forecast, the big growth engines are clearly computing. Computing mostly driven by AI, machine learning, and automotive, driven by electrification. Computing is actually set to become the biggest single piece of the pie starting this year, growing around 9% a year through 2030. But, and this is really key for Navitas, the fastest growing segment overall, that's automotive, looking at about a 10% growth rate each year until 2030.
Okay, why is automotive so crucial for power semis specifically?
It's the shift to electric. It fundamentally changes what's inside a car. The amount of power semiconductor content, the value of those chips, is something like 6 times higher in an EV compared to a traditional gas-powered car.
6 times?
Yeah.
Just for power management?
Yeah. You're going from managing, little bits of power for the radio and dashboard lights to handling these massive high-voltage battery systems, drivetrains, charging. It's a whole different world. Analysts think the total semiconductor value in a car could hit $1,350 by 2030.
6 times the power semi content. That's a huge demand multiplier aimed right at Navitas's sweet spot.
Precisely. And this brings us back to why that wide bandgap market, the GaN and CC stuff, is just booming. This is the proof point for their whole strategy. The market share for WBG materials in automotive power systems is forecast to just skyrocket. It was only about 12% back in 2023. Analysts see it hitting 29%, representing a market value of nearly $17 billion, $16.8 billion to be exact, by 2028.
Wow, from 12% to almost 30% share in just 5 years.
Yeah, it's not just growth, it's a massive shift in materials, a transition away from older silicon and things like inverters and chargers. And Navitas is positioned right there, ready to catch that wave.
Okay. The future looks incredible. $17 billion WDG market, 6 times the content per car. I can see why people get excited and why the stock's up 259%. But now we hit the brakes, the reality check. Tomorrow's Q3 2025 earnings report. It seems like it tells a completely different story. What are the sources telling us about their current financial health right now?
Yeah, we absolutely have to ground ourselves in the present, especially with earnings literally hours away. For Q3 2025, Navitas management themselves guided for revenue of $10.0 million, give or take $500,000. And the Zacks consensus estimate, it's right there, $10.1 million.
$10 million. For a company with that kind of stock run, I mean, that sounds really bad, not great.
It's a huge contraction. That $10.1 million consensus figure, it points to a massive year-over-year decline. We're talking 53.4%.
Down 53% from last year.
Exactly. So even with this tech revolution happening all around them, their actual current business, their sales, are shrinking dramatically, and profitability still not there. The market's expecting a loss of about 5 cents per share. Now, that is slightly better than the 6-cent loss they had a year ago, but it really hammers home that they're still in that heavy investment phase, not yet making money, not yet at scale.
So the market knows revenue is expected to drop by more than half, and they're still losing money. Yet the stock is up 259%. It feels like investors are just completely ignoring today for tomorrow.
That's exactly what's happening. It's a classic case of looking way, way out into the future. They're basically saying, we don't care about 2025's results because we believe the revenue will eventually explode to match the tech potential. But boy, that's a big bet on execution, isn't it?
Huge bet. Is there any chance of a positive surprise tomorrow, an earnings beat?
Well, the data isn't suggesting one. Zacks has this model, their earnings ESP, which tries to predict beats. Right now, Navitas has an ESP of 0.00%. Zero. And it has a Zacks rank #3, which is a hold. Put those together, and the model pretty strongly suggests the results will likely land right in line with these, frankly, quite weak expectations. Steep revenue drop, continued losses. The present is tough, but the stock price is living in 2028.
Okay, let's pivot back then. Let's get back to the bull case. That 259% rally must have some concrete reasons beyond just GaN is the future. What specific things are Navitas doing strategically to convince people that this revenue dip is just temporary and the big story is still on track?
Well, ironically, the optimism is largely driven by the strategic moves that are causing this immediate revenue pain. They're deliberately shifting focus, moving away from some areas and towards markets where the potential payoff, the margins, the volume could be vastly larger down the road. The biggest driver everyone points to is the AI data center advantage. Generative AI, it just needs insane amounts of computing power packed tightly together, and that requires a whole new way of delivering electricity efficiently. Data centers are moving towards these new high-voltage systems, often 800-volt DC architectures. That's the perfect application for GaN and SiPh. Navitas is specifically developing next-gen power devices for these 800-volt systems, targeting platforms like NVIDIA's new AI factories. Their chips allow for super-efficient power conversion right from the grid, which is critical for managing the massive electricity bills and the heat these AI clusters generate.
So they're solving a key bottleneck for the AI giants. That makes sense. But again, the Q3 revenues suggest they aren't shipping truckloads of this stuff yet.
Not yet. It's future revenue. And that's tied to their big strategic market shift. Analysts, like those at Needham, they actually see this pivot as a positive long-term move. Navitas is consciously pulling back from the lower-margin mobile fast charger market, especially in China. That move definitely hurts revenue. Now it explains a chunk of that 53% drop.
Okay.
But the bet is that by focusing all their energy and resources on the really high-value, high-power stuff, data centers, EVs, energy infrastructure, they'll get much better profitability and growth momentum starting maybe in 2026 and beyond.
Wait, but if they're pulling back from mobile, why do we hear about partnerships like Xiaomi? Doesn't that seem contradictory?
That's a good point. It needs a bit of nuance. Even within mobile, they seem to be focusing only on the really high-end, innovative stuff where GaN truly shines and where margins might be better. That Xiaomi partnership, for example, resulted in the world's smallest 90-watt fast charger. That's a big technical win, showing off what GaN can do compared to an old, bulky 12-watt silicon charger. It's about demonstrating capability, not necessarily chasing huge volumes of cheap chargers anymore.
Gotcha. So showcase pieces, not commodity volume.
Exactly. And meanwhile, they are building these foundational wins in the industrial space. They launched that digital power joint lab with GigaDevice, and that's already producing real hardware for the target markets. Things like 4.5 kilowatt and even 12 kilowatt server power supplies, a 500-watt solar microinverter. These are high-power, high-value components going straight into those AI data centers and energy systems they're targeting. Plus, they have relationships with other big players. Samsung's mentioned too.
Okay, so they have a clear roadmap for where they want to sell. Is there any tangible proof this pivot is working? Like actual orders?
Yes, and this is a huge part of the bull case. They've reported a $450 million design win backlog.
$450 million?
Yep. That backlog represents customer commitments for future orders spanning several years across these key target markets: EV, data center, energy. Now, compare that $450 million potential future revenue to the $10 million they're expected to report for this quarter. You see the gap.
It's enormous.
That's why the bulls are so convicted. They're looking straight past tomorrow's $10 million and waiting for that $450 million pipeline to start converting into actual sales on the income statement.
Okay, that's a massive pipeline.
Yeah.
But how do they actually scale up to deliver that? And more importantly, how do they make money doing it if they're losing money now?
Right, and that brings us to maybe the most critical technical catalyst for the bulls, the cost reduction and margin strategy. They're working with a partner, PowerChip, to move their GaN chip manufacturing from older 6-inch silicon wafers to modern 8-inch wafers.
Okay, bigger wafers. Why does that matter so much?
Think of it like making cookies on a baking sheet. If you switch from a small 6-inch sheet to a larger 8-inch sheet, the basic process, the oven time, it doesn't change that much, right? But the area of the sheet increases significantly mathematically. It's over 75% more surface area.
So same basic effort, but way more cookies. Or chips in this case.
Exactly. They expect to get about 80% more chips off each 8-inch wafer compared to a 6-inch one without the production cost going up nearly as much. This is their path to manufacturing efficiency. Lower cost per chip means better gross margins down the line. It's absolutely vital if they want to profitably handle the kind of volume that $450 million backlog represents, and maybe even get to positive EBITDA, which some analysts are projecting for 2026.
That manufacturing scale-up sounds key, and we should also mention briefly the leadership change back in September.
Yes, good point. Chris Alexandra took over as CEO from Gene Sheridan, the founding CEO. That happened right in the midst of this whole strategic pivot. Often, a new CEO comes in specifically to manage a big transition like this, shifting the focus towards scaling up manufacturing, improving margins, maybe being less focused on just chasing any revenue, especially low-margin revenue.
Okay, the bull case is definitely compelling. You've got the AI and EV future, the big backlog, the 8-inch wafer efficiency gains. But we have to be objective. A 259% rally alongside a 53% revenue contraction just screams risk. What are the big red flags, the bear arguments the sources are highlighting? Let's start with the immediate problems.
Yeah, the risks are significant. And they kind of fall into three main buckets. There's the immediate pain from that strategic shift itself. There's weakness in the wider market. And then there's the elephant in the room, the valuation. So, starting with the operational pain. Geopolitical and China risks. That revenue drop expected tomorrow, it's not just about shifting strategy. Management explicitly said Q3 revenue would be hurt by ongoing tariff issues in China. And remember, that strategic decision to pull back from low-margin mobile, a lot of that business was in China. So pulling out of that revenue stream while also facing tariff headwinds in the region, it's a double whammy. It guarantees, as they put it, a few softer quarters until the new projects wrap up.
Right, so the stock isn't just bidding on perfect execution of the pivot. It's also bidding that trade frictions ease up so they can actually capitalize on these new deals without getting hit by tariffs. That's layering risk on top of risk.
It absolutely is. And on top of that, they're dealing with broader market weakness. Yes, the long-term picture for EVs and industrial tech looks great, but right now things are a bit sluggish. The sources specifically mention lower demand expected in both the EV and industrial markets impacting Q3. So they're pivoting into markets that are facing some temporary softness right after abandoning a market that, while low margin, did provide volume.
Okay, so operational pain, market softness. Which brings us to the biggest risk factor you mentioned, the valuation.
Yeah, this is where it gets really uncomfortable for the bears and, frankly, even for some bulls. When a company is deliberately shrinking its revenue, even for good strategic reasons, you'd expect the valuation multiple to be, reasonable. Navitas's is, well, it's astronomical. We measure this often with the price-to-sales ratio, the PS ratio. Navitas's forward 12-month PS ratio is currently sitting at a staggering 53.43 times sales.
53 times, just to put that in perspective. What's normal for this industry?
Well, normal varies, but the industry average PS is around 10.15x. And if you look at established profitable peers, companies like Lam Research, Marvell Technology, Ambarella, their multiples are typically in that 8x to 10x range.
So NVTS is trading at 5 or 6 times the valuation multiple of its often larger profitable peers, even while its revenue is currently shrinking and it's losing money.
Exactly. It's an extreme premium. The market is essentially saying, Navitas, we expect you to grow your revenue 50-fold and do it fast and do it profitably. That kind of multiple leaves zero room for error.
What does that demand in terms of execution?
It demands perfection, what analysts often call flawless execution. It assumes the 8-inch wafer transition goes smoothly, that the $450 million backlog converts quickly and without issue, that the adoption of that 800-volt architecture in data centers happens even faster than people think. And this huge valuation risk is exactly why some on Wall Street started getting nervous. Rosenblatt, for example, they actually downgraded the stock from buy to neutral recently.
Even while raising their price target, right?
Yep, right. Which shows they still believe in the long-term tech story. But the downgrade was purely about valuation. They pointed out the stock was trading at something like 60 times the consensus revenue estimate for fiscal year 2026.
60 times 2 years out.
Wow. And their warning was pretty clear. Expectations for that 800-volt data center growth might be getting ahead of reality over the next couple of years. If that adoption is even slightly slower than baked into the stock price, that high multiple is incredibly vulnerable.
Yeah. This is definitely a complex situation. Two completely opposite stories playing out. You've got this vision of Navitas powering the future of AI and EVs, backed by real technology, a huge backlog, a path to better margins. But then you have the present day. Shrinking revenue, risks in China, temporary market weakness, and this just incredibly demanding 53 times sales valuation. How do we pull this all together? What's the consensus view for someone trying to make sense of this?
The synthesis really points towards, let's call it cautious optimism, heavily weighted by risk. The underlying foundation, the technology, the strategic positioning, it looks really solid. That shift to high-power GaN and CNC, targeting the right growth markets, plus that clear path to better margins with the 8-inch wafer move, it confirms they have a strong potential competitive edge long-term. The tech story itself is really compelling.
So the company seems built to win eventually, but the stock price looks like it's assuming they've already crossed the finish line.
That's the core tension, exactly. The sky-high valuation, 5 times the industry average PS, combined with the very real near-term headwinds, the execution risk of the pivot, the China situation, It just screams for caution. That price tag basically demands perfection, and perfection is rare. Any slip up, any delay in converting that backlog, any problem scaling up 8-inch production could hit the stock hard because there's no margin for error built into the price. And you see this reflected in the analyst community. They're confident but measured. We saw that consensus price target nudge up a bit from around $6.74 to $7.24. That says they think the story is worth more than before, but it's not a signal of, imminent explosive growth. It's tempered optimism.
So when you balance that incredible future potential against these very clear present dangers and the high price, what's the bottom line takeaway from the sources? Buy, sell, hold.
The overall recommendation, kind of mirroring that split view on the street and the risk-reward balance, leans towards hold right now. This is really an investment that requires patience, a long time horizon, and honestly, a pretty high tolerance for volatility and risk. You're basically holding on and waiting for the actual financial results, that $10 million quarterly revenue, to start climbing steeply towards the promise implied by the $450 million backlog and that 53x multiple. The future could be bright, but the path there over the next year or two looks pretty treacherous.
Okay, a hold? Wait and see if the reality starts catching up to the hype.
Essentially, yes. We've seen how Navitas's big bet on high-efficiency changes and SIAT positions them perfectly for where AI and EVs are heading. They're banking on a fundamental need for better power management globally, but that very strategy means accepting some pain right now in these current numbers.
So the key takeaway, the knowledge nugget here, seems to be understanding the massive trade-off the market is making. Betting heavily on future tech while overlooking current financial strain and risk. For you, listening in, the crucial things to watch now are, how quickly does that 800-volt data center market really take off? Because that's what justifies the price. And listen closely to tomorrow's earnings call, not just for the headline revenue number, which we expect to be weak, but for any clues management gives about the timeline. How fast can they scale up that 8-inch scanning production and start improving those margins? That wraps up our deep dive into Navitas Semiconductor for today, a really fascinating high-stakes story. As always, if there are other companies you're curious about, companies you want us to unpack like this, definitely leave us a comment below. Let us know who we should dive into next.